So it's a nice time we meet again, team accounting, for this session of advanced financial reporting. So for today, we are going to cover a consolidation. That is, we call it group accounting, or we call it business combination. And for this part, it will be concerning the advanced financial reporting. That is section 6 of the CASNET. So according to consolidation, you know that by the end of the financial year, according to the RIGO framework and institutional framework, any entity, that is any parent company, as a subsidiary, it has to consolidate the operations of that subsidiary and present consolidated financial statements during the AGM to the shareholders. That is what we call institution and RIGO framework. So according to the law and according to the standard. So that is according to the law under section 154 subsection 1 of the Companies Act. And according to the institution, the relevant accounting standards, it's according to International Accounting Standards 27, whereby organizations are supposed to be consolidated by the parent company. So when a parent company has a subsidiary company, it has to do the relevant consolidation. Even other investing companies, because you could find that it's not only the subsidiary which might be controlled by the parent, but we might have associates and joint ventures. So in our last videos, in our last sessions, in our last live classes, we introduced this topic whereby I covered the better part of the basics you need to know in order to do a question of consolidation. So now, in order now to illustrate, and at the same time, I will be going point by point to explain what is supposed to be done. Even if you never became conversant with the basics, again, I will do a repetition of the same. Now, this would be based on the questions which we will do. So now to start with, I will start with the question of June 2011. So this question was concerning whereby the parent acquired a subsidiary, then another subsidiary. So whereby the parent acquires a subsidiary, then the subsidiary acquired another subsidiary. So which means that the parent will be having a subsidiary and a sub-subsidiary. So it was a question which was tested by CASNEM, which is the examining body for the accounting exams. So this is the relevant question. So they say that Host Limited, its subsidiary Super Limited, and sub-subsidiary Sport operates in the media industry. So the following financial statements relates to the three companies for the year ended 31st December 2010. So we continue to the next part of the question. So because here now you can see we are told it's just Host Limited and its subsidiary Super and the sub-subsidiary Sport, which is in the media industry. So the examiner provides an income statement for the three entities, the parent, the subsidiary, and the sub-subsidiary, as we have been told already. So the data is provided, so you don't have time to read again this. Then again, you have a statement of financial position. Again, the data is provided. So our main concern now is this additional information. This is what we call the relevant in this question. In any question of anyway accounting, if you can be able to understand what is concerning the additional information, you can be able to tackle the question with retro time. So they say that Host Limited acquired 90% of the ordinary share capital of Super Limited on 1st January 2005, when the retained profit of Super Limited was shillings 1,425. So subsequently, Super Limited acquired 80% of ordinary share capital of Sport Limited on 1st January 2007, when the retained profit of Sport was shillings 950 million. So number two, during the year 2010, Sport Limited sold goods to Super at a selling price of 80 million, making a profit of 25% on cost. 75 million worth of these goods was still in the inventory of Super at the end of the year. So at the end of the year, so Super Limited still owned, so there's a full stop here. Then we say Super Limited still hold the spot shillings 100 million as at 31st December 2010. So like now here it's very simple. It's only that they are telling you that Spot sold goods to Super, selling price is 480. So 480 is a intergroup sales. So when Spot was selling goods to Super, he made a profit of 25% on cost. So when you hear he made a profit on cost, that is a profit markup. So when Spot was selling goods to Super, he sold them at 480, making a profit of 25%. So that is a profit markup, which was included on the goods sold. So, but now the entity which received these goods, which is called Super, at the end of the year, he has not resold all the goods. That is why you are told here, 75 million worth of these goods was still in the inventory of Super Limited at the end of the year. So since now the 75 million worth of the goods are unsold by the entity which received them by the end of the year, it means that that entity has not realized the entire profit. So which implies that there is unrealized profit on the stock. Because now the 75 million of the goods were unsold by Super. And remember, Super is the one which received the goods and they paid Spot. Then we are told that Super Limited still hold Spot Limited 100 million. So obvious now this is an intergroup owing or in an intergroup balances. An outstanding amount, a debt which has not been paid. So we said that when we have a balance which the parent and the subsidiary owes each other, and the amount has not been settled by the end of the relevant financial year, this amount is supposed to be cancelled out. So what are you supposed to do? You deal with two accounts, trade receivables and trade payables. So what you do to the trade receivables is that you credit, and what you do to the trade payables is you debit. So debit trade payables, credit trade receivables. That is how you cancel out an intergroup owing which has not been settled by the end of the year. The number 3, you are told that during the year 2010, Super Limited sold goods to Host Limited at a selling price of 260 million, making a profit of, so that is making a profit of, so I need to adjust this. So the relevant percentage we were supposed to be included in that relevant additional information is supposed to be a third. So that is what, so this is what I was, so this is a third. So they say that during the year 2010, Super Limited sold goods to Host at a selling price of 260, making a profit of a third, on cost, on cost. So shilling 60 million worth of these goods was still in the inventory of Host Limited at the end of the year. So Host Limited still holds Super Limited shilling 50 million as at 31st December 2010. So and this one implies that again is the same as additional information number 2, because they say that Super sold some goods to Host. Selling price you are told is 260. So when he was selling, he made a profit of a third on cost. So that is an intergroup sales anyway. So when he was selling, he made a profit markup. That is included a profit markup, because I said when you are told on cost, that is a profit markup. But now the entity which received these goods, which is Host, never resold the entire goods by the end of the year. Because you can see here, 60 million worth of the goods. So remember the total goods was 260. but now 60 worth of the goods was still in the inventory of host at the end of the year. So we have to compute unrealized profit on stock. So we have to determine the unrealized profit on stock, which host never realized because he never resold all the goods he received from Super. So then we have host limited still hold Super shillings 50 million as at 31st December 2010. So this is another intergroup owings, so which we need to cancel out by crediting our trade receivables and debiting our trade payables. The number 4, during the year, Host Limited sold an item of plant to Super Limited at a selling price of shillings 240, reporting a profit of 20% on cost. So the charges, the group charges depreciation at the rate of 20% on cost, and this is included as part of cost of sales. So which means that during the year, Host sold an item of plant to Super at a selling price of 240. So this implies that there's a fixed asset which is sold, and this fixed asset, we say that once a fixed asset is sold to another entity, the other entity will never resell that fixed asset. So a fixed asset is not meant for resale. So which means that when Super received the fixed asset, he will never resell it. He will use it for the business purpose. So which means that he will never realize the profit he paid Host. So because in our Host Limited is the one which sold goods to Super. This is not goods, but fixed asset, which is plant. Host is the one which sold the plant to Super at 240. So including a profit of what? 20% on cost. So this 20% on cost, the profit markup, the profit, that is the 20%, will never be realized by Super. Why? Because it will never resell the asset. So we need to determine the unrealized profit on fixed asset, unrealized profit on fixed asset, so that we will be able to adjust our retained earnings account and our property, plant, and equipment account. Because you know that once they did what? They did an intergroup sale of fixed asset, then the other one never resold the relevant asset, which means that they never realized the profit. So the profit of one entity, like now here, the profit of Host is overstated. And remember, they are group members. So to avoid profit overstatement, that is why I'm saying you need to determine that and realize the profit on fixed assets, which Super never realized. Then you adjust your PP account by crediting. Then again, you adjust your retained earnings account by debiting. But on my scenario, I will never be using T accounts. I will be telling you where to subtract and where to add. But for the accounting purposes and according to international standards, you need to know why am I subtracting here, why am I adding in this account. So that is why I have started by interpreting the question. Then they say that the group charges depreciation. We said obvious that when there's an intergroup sales of a fixed asset, obviously you would find that the two entities which were transacting will charge depreciation on the asset. Like now they say the group charges. Remember, the group is the parent and all its subsidiaries. The parent and all its subsidiaries, which means that Host was the parent, Super was a subsidiary. So both of them, they charge depreciation on this asset. So which means that they overcharged. They overcharged. So they did a depreciation overcharge. So we need to determine depreciation overcharge by taking unrealized profit on fixed assets. You multiply with the depreciation rate of 20%, which is given. So, and you need to know that if they did an overcharge of depreciation, obvious, they have affected our profit because now the profit will be understated because now you know the excess depreciation will affect our profit, and at the same time, it will if they did an overcharge to the asset, if they did a depreciation of the asset, obvious again, they affected the PPE, the property, plant, and equipment account. They understated that account. So now to correct that is why we obviously adjust
our property, plant, and equipment account by debiting, because now you add back the depreciation overcharge. When we debit PPA account, is like we are increasing that account. So when I say we debit PPA account with the depreciation overcharge, we are correcting that an overcharge which was done. Then we do what? We credit our retained earnings account. But never be worried about the debit and the credit. The better thing is that, do you know how to compute unrealized profit on fixed asset? Do you know how to compute depreciation overcharge? Before even that, do you know how to identify that this additional information needs this and this? So for the others, I will show you on how to do, other than the debit and the credits I'm mentioning. But again, the debit and the credit, it's for more understanding, and that is the requirements of the international accounting standards. The number 5, the entire goodwill of Super Limited had been impaired, and by 31st December 2009, 60% of the goodwill of Sport Limited was impaired. An additional half of the balance of the goodwill in Sport Limited is considered impaired. The group uses partial goodwill method. The group uses partial goodwill method. So the examiner was not that bad, because he was in need of just 3 things. And this is what will be required anyway to do in any consolidation question. Maybe beside the goodwill, maybe you can be told again to do goodwill as a requirement. But this one, there was no requirement of goodwill. They just needed a consolidated income statement, consolidated statement of changes in equity, that is retained profit only, and the consolidated statement of financial position. So with that interpretation, we can go and now do the presentation of a consolidated income statement. So now this is concerning an income statement.
This is concerning an income statement. So now you always start from the way the income statement is. That is how you always do it, with the relevant adjustments which you are supposed to carry out. So when I say the way income statement is, I mean that you go back to your income statement, you check what you are given. So before that, I need to interpret something here. So before even we start the income statement, let me interpret something which is very major. So this is what even you are supposed to start with, even before we talk about the income statement. So the structure and shareholding. So this is what I was supposed to start with. And this is what you are supposed obviously to start with. So the structure means that host acquired. So you were told that host acquired super and the super acquired sport. Super acquired sport. So host acquired super up to 90%. So we have 90%. And here we have 80%. We have the 80%. So remember that host is the one which controls super and sport. So up to which percentage? So host in super. So host in super. So host in super. So this one means it's a direct control of 90%. Then we have an NCI of 10%. So this one makes us to be 100%. Then we have host in sport. We have host in sport. So host in sport, that is 90%. You multiply with 80%. So this one gives us 72. So I'm taking 90 times 80 in order to get the control in sport. Because now host controls sport through super. Host controls sport through super. And host was controlling super up to 90. He was not controlling super up to 100%. So now in order to get the control in sport, you have to take the 90%, which your host control in super, you multiply with the 80%. Because now host used the super where he controls up to 90 to invest in spot up to 80. So to get now the indirect control of host in spot, you have to take 90% times 80. So that the remaining percentage of 28 is what we call the NCI, so that we make it to be 100%, in order to make it to be 100%. So then after that, we go back now to what I was saying. You start with revenue. You start with revenue. So starting with revenue, you just check what you are given while considering if the relevant subsidiaries were present in the entire period. Obvious, according to question, because already I've read it, that is why I'm not talking about many things. These hosts acquired super and sport, the way we have just interpreted in our structure. When did they, in which period these subsidiaries and subsidiaries were acquired? So right now here in additional information number 1, you are told that host limited acquired 90% of ordinary share capital of super 205. Then note 2, you are told during 2010, sport sold goods. Before that, I was looking for the time when sport was acquired. Let's check in addition information number 1 anyway. So in addition information number 1, you can see that super was acquired on 1st. Super was acquired in 1st January. This 1st January. Then sport was acquired in 1st January 2005. So this is 1st January 2007 and this 1st January 2005. But when are we preparing our books? Our books are being prepared as at 2010. It's prepared as at 2010. So which means that both entities, that is the super and the sport, were present for the entire period. Because now they were acquired in 2005 and 2007. So in the current year, 2010, when we are preparing our book, it means that they were present for the entire year. Which means that if the subsidiaries are acquired during the year, remember that you have to apportion, you have to consider from the period when they were present. And that is the essence of interpreting those dates. So since we have seen that they were acquired 2005 and 2007, so in the current year, they were present for the entire period. That is from January to December of 2010, they were present. So in order now for host to consolidate super and sport, you will be taking the revenue. Like now we start with revenue. You take 45,600, you add 24,700, you add 22,800. So you add the 3 because all of them are group members. Yeah, we don't have an associate or a joint venture. So then you do the relevant adjustment. Like now under revenue, we just subtract intergroup sales. And the intergroup sales, I say, or you need to know, even if I never said, the intergroup sales which you need to subtract here is the one which occurred in the current year, that is in the year 2010. Like now, when I will be taking revenue, 45,600 plus 24,700 plus 22,800, I will come and subtract my intergroup sales down here. Remember, there's these intergroup sales which occurred during the year. Note 2, they say, during the year 2010, there was a goods which was sold. This goods of 480 is fine, that is an intergroup sales. Now, note 3, they say, during the year 2010, Super Limited sold goods to host. That is another intergroup sales of 260. Then the third one is this one for asset. During the year, host sold an item of plant to super at a selling price of 240. So you raise all those intergroup sales. And what you can see there, during the year, during the current year, during the year, during the year. So during the year 2010. So if they could have been taken place in 2009 or 2005, you ignore that intergroup sales. So for you to subtract the intergroup sales in the revenue, the intergroup sales must be during the current year under consideration, and that intergroup sales must have taken place between the group members, that is, parent and all the subsidiaries. So let us record. There's nothing else I need to talk about revenue. And that is the only adjustment you can do concerning revenue. So here we take 45,600 plus 24,700. You add 22,800. So what you subtract here is the one which are intergroup sales, which I've already talked about. So the note 2, there was this intergroup sales of 480. Then there's another one of note 3, the one I've just talked about, 260. And note 4, there was an intergroup sales of plant of 240. Then here you come and do cost of sales. So the cost of sales. So for the cost of sales, again, we do the same, parent plus subsidiary. So the parent is 18. So that is 18,050. You add, so anyway, let me use my, so that is 18,050. Then we have 54,63. And then after that, we add 53,20. Then what you do here, you subtract the same intergroup sales. The 480, the 260, and the 240. Then after doing that, there's other items you need to adjust with. So after doing the relevant adjustments, so I will be doing my workings on a new page or on a new area. So after subtracting the relevant cost of sales, after subtracting the relevant intergroup sales under the cost of sales, you need to add back the unrealized profit on stock, the UPS. The unrealized profit on stock, UPS. So you need to adjust UPS. So unrealized profit on stock, we said it's unsold goods. Unsold goods terms, profit margin. Unsold goods terms, the profit margin. So out of these goods, 480, 260, and 240. But under 240, remember there was an intergroup sale of fixed asset. So under that, you need to check UPFA. And there is profit on fixed asset, which you need to check the value at which the asset was transferred. So transfer value of the asset, then the profit margin. But for the others, it's UPS, the unrealized profit on stock. So let's get the unrealized profit on stock for 480, the goods of 480. So the entity which received them, like now the one for 480, the goods worth 75 were unsold. The goods worth 75 were unsold. That is what you are told here. During the year 2010, Spot Limited sold goods to Super at a selling price of 480, making a profit of 25% on cost. So 75 million worth of these goods were still in the inventory of Super at the end of the year. So Super still owed. So for the owing, we are not up to that point. So for now, we are looking for the unrealized profit on stock. So when Super received these goods from Spot, he never resold 75. But remember that when Spot was selling the goods, he included a profit markup because now 25% on cost. So 25% on cost, that is like a quarter. So a quarter. So a quarter, it means this is a markup. So we need to change it to margin. So to change it to margin, I will say 1/4 plus 1. So I need to add the numerator to the denominator so that I get a fifth. So after getting a fifth, so that I will check the unsold goods, which is 75 times a fifth. So 75 divided by 5. 75 divided by 5. What are you getting?
15.
15, eh? So that is 15. So 15 is my first intergroup sales. Then what about the second one? For the goods of 260? For the goods of 260, the entity which received never sold 60 million worth of the goods. That is according to additional information number 3. So during the year 2010, Super Limited sold goods to Host at a selling price of 260 million, making a profit of a third on cost. That is again markup. So margin is, if markup is a third, margin is
Quarter.
a quarter. Because now you take a third, you add the one to the numerator. So that is a quarter. So remember that Host is the one which received the goods, and he never sold 60 million worth of the goods by the end of the year. So they were in the inventory at the end of the year. So you need to take that a quarter of 60. So again, this is 15.
Yeah, 15.
Again, this is 15. Eh? So remember, this is a UPS on closing stock. This is UPS on closing stock. Because now I'm saying on closing stock because the goods were never resold by the entity which received them by the end of the year. That is why I'm calling them UPS on a closing stock. So since they are UPS on closing stock, you need to add. So what you do here, you need to add. You have to add. So I will add 15 plus the 15. Then I will add my UPFA, unrealized profit on fixed asset. So the unrealized profit on fixed asset. So in order to get the unrealized profit on fixed asset, again, I need to do a working. So this is the relevant working I would do for the unrealized profit on fixed asset. So unrealized profit on fixed asset, already we have the formula here. So the variant with the asset was transferred, that is the transfer value, then the profit margin. Because obviously, as I said, when there's an intergroup sale or fixed asset, the other entity which received that fixed asset will never resell it. Eh? So since you will never resell, you will never realize the profit. So right now, you are told that number 4, that is additional information number 4. During the year, Host sold an item of plant to Super at a selling price of shillings 240, reporting a profit of 20% on cost. So that is a markup again. So the group charged depreciation. So for depreciation, we are not concerned it for now. Anyway, but I would have to adjust again the relevant depreciation overcharge under cost of sales. But for now, I'm looking for the unrealized profit on fixed asset. And remember that you will never be told that like now the entity which received the asset, they resold. You will never be told that he never resold. Eh? You need to know that when there's an intergroup of fixed asset, the other entity which will receive that asset will never resell it. It's not meant for resale. So, but now remember, like now here, when Host sold goods to Super, I don't know why I'm using goods, and this is a fixed asset, sold for that. So when Host sold an item of plant, this is a fixed asset, which means that Super never resold it, but Host realized the profit. So what we do, we take transfer value. The asset was transferred at 240. You multiply with the profit margin. So if a markup is 20%, 20% is like a fifth. So margin will be a sixth. So that is 240 times a sixth. Because now I've taken 20% is a fifth plus the one, the numerator, the denominator. That is 1/6. So this is 40. This is 40. Then again later, I will come to check for depreciation overcharge. I will come to check for depreciation overcharge. Because now when they were transacting, both of them, they charge depreciation on this plant, which was sold. So which means that in order to get depreciation overcharge, you always take UPFA times, you take UPFA times depreciation rate. So that is 40 times depreciation rate, I think it was 20%. This one you will be given, the percentage is given. The percentage is given. So you are told the group charges depreciation at the rate of 20% on cost. So which means that is our answer for depreciation overcharge is 8. So we have a UPFA of 40 and depreciation overcharge of 8. So let us adjust our UPFA first. Then I will be able to mention what we are supposed to do next. So here I need to add 40. So after adding 40, I need to adjust only two things which are remaining. That is depreciation overcharge or depreciation undercharge. But before that, if there was UPS on opening stock, you are supposed to raise. So on opening stock, it means that if there was some goods which were unsold by the end of the previous year, remember that we do the same and there is profit on stock, then that one is subtracted. Then now for the depreciation overcharge and undercharge, for the overcharge, that is depreciation overcharge, that one is subtracted, the depreciation overcharge, then undercharge, it's supposed to be added. So you add the depreciation, undercharge, then you minus the 8. You are supposed to minus 8. That is depreciation overcharge. So depreciation undercharge, remember that arises due to revaluation, and there was no revaluation in this question. And remember that I said for you to be given revaluation, you have to be told that the fair value of the asset was this and the book value was this. So you subtract the two. Or you can be told that the fair value of the assets of a certain maybe subsidiary was in excess of the book value by a certain amount. Or you can be told that the book value of certain assets for the certain subsidiary was below the fair value by a certain amount. There was no statement of that kind. So once you are done with the cost of sales, and that is what you can adjust in any question, taking cost of sales and you subtract from the revenue, you are capable of getting a gross profit. Then after getting a gross profit, remember that now we go to the distribution cost. And this one is just direct. You take the parent plus subsidiary. Parent plus subsidiary. So the parent is 3325 plus 2137 plus 1900 plus the 1900. The next, admin. So this just I'm picking from the question direct. There is no adjustment. So 3475 plus 950 plus 1900. Then after that, if you can check your income statement, there is a finance cost, which you are given there. But before I talk about finance cost, I have to introduce impairment. I have been taking these items here. I've been taking for distribution, it's just adding direct, parent plus subsidiary plus sub-subsidiary, the same with administration expenses. So I'm talking about this finance cost of 325. So I will record that one, but before I record it, there's an expense which is not here, which I need to introduce. So, and that one is called impairment. And what's impairment, my good students? Just I need a definition. What is impaired? Which asset is impaired?
Goodwill.
So goodwill is impaired. So once we will be able to do goodwill later, we will be capable of coming up with the impairment. we would be capable of coming up with the impairment. And that impairment needs to be introduced under these expenses because now it has not been recorded and it will be brought about goodwill which is computed. So for now, I will just write impairment. We will just continue with our other items which are direct before we go to the additional information of doing that goodwill. So here we introduce impairment. And this one needs a working. So I will write working. Then I will say profit before interest and tax. Profit before interest and the tax. Profit before interest and tax. So that I will be capable of subtracting now the interest. Interest now is the finance cost. Interest is the finance cost. So the finance cost here, I need to put it at the far end there, 325. So after getting 325, I would say profit before tax. Profit before tax. So I will raise tax. I will raise my income tax. So the income tax which is supposed to be subtracted here is for the parent and the subsidiary. So for the parent and the subsidiary and the sub-subsidiary. You know, even that subsidiary just a sub-subsidiary. So for that one is 1809, 5390, and 4241. That is the tax. So the tax here, and remember this one I needed to cross that way. So the tax here is 83 plus 5390 plus 4241. Then after getting that relevant tax, we always say that we have a profit. We have a profit after tax. So we have a profit after tax there. So after now getting profit after tax, remember that the parent has been consolidating these entities free. He has been consolidating them fully. And you know that the parent doesn't control the relevant subsidiaries which are there up to 100%. But he controlled them up to 90% and up to 72. I think you remember when I started by drawing the structure, whereby we said that he controls super up to 90 and he controls host up to 72. So which means that there is an element of 10 and there's an element of 28 here, which we have not taken into account. So which means that after getting the profit after tax, the parent must share some profit to the non-controlling interest. So profit attributable to NCI. Then the profit attributable to parent. Then the profit attributable to parent. Now the balance which is remaining will go to the parent. So the profit attributable to parent. So I need the answers from the revenue, cost of sales, distribution, and so on. So again, I will be confirming with my calculator. So I need you to compute, guys. So for the first one, I'm getting 92, 120. So you can confirm that.
92 and 20.
Yes, the second one, I'm getting 27, 915. You can confirm that. Then if I subtract the 2, it's supposed to be 64, 205. Then for distribution, this is supposed to be 73, 62. Then this is supposed to be 63, 25. So remember that we don't have impairment, but we need to compute it later. So which means that I cannot be able to get profit before interest and tax. So this finance cost was supposed to be subtracted. Then for the income tax is 17,931. That is 17,931. So that we get the profit after tax there. So now to make sure that our income statement is complete, we have to go forward and do goodwill so that we be able to determine the relevant impairment. So let us go direct to the computation of goodwill. So goodwill, in order to do goodwill, you know that goodwill is equal to purchase consideration. It's all about purchase consideration. You minus the share of net assets, the share of net assets acquired. So you subtract the net assets acquired. So for the net assets acquired, you know that these are all about equity items which were acquired, and this is the amount which was paid by the parent company in order to acquire that relevant investing company. So like now here, you need to know that we need to do the goodwill of two entities. So we need to do the goodwill of the two subsidiaries. One is a subsidiary, another one is a sub-subsidiary. So which means that for super and sport, so for those two entities, which method are we supposed to use? Because you can either use full or you can either use partial. And you know very well that in order to use the full method to compute goodwill, you must be given the fair value of non-controlling interest. So which means that the NCI must be stated at its fair value for you to use the full method. You must be given the fair value of non-controlling interest. So for partial, NCI is not measured with its fair value. So there's nothing like fair value of non-controlling interest. So in this question, the examiner was even direct. The examiner was direct. He never made you to struggle. In the last additional information and in the last sentence here, he said that the group uses partial goodwill method, but it's not a must to mention this. We can even remove this. If we could have removed this, again you could have determined which method to use. Because obvious, even if we remove that one, you need to know that for you to use full, you must be given the fair value of non-controlling interest. So if there is no fair value of non-controlling interest, obvious use the partial method. Beside, if you are not given the fair value of non-controlling interest, you can compute it if you are given the market price of the ordinary shares of the subsidiary. I think you remember the example we did. So in some scenarios, you might not be given the fair value of non-controlling interest, but you would find that you are given the market price of the ordinary shares of that relevant subsidiary. So obviously you have to take the market price, you multiply with the ordinary shares of that subsidiary, then you multiply with the rate of the percentage that is of that NCI. So if it was, for example, 10% for super, then you are told that the market price was 20 shillings and the ordinary shares were a certain value. So you take those ordinary shares, you multiply with the 20 shillings times 20%. That is 10% times the 10%. So let us do, of which we can do both of them together. We can do the goodwill of these two entities together. because both of them, they just need a partial method. So I will write shillings. So I'm doing the goodwill of super, one column for the sport. At the same time, I could have computed them separately, but due to avoidance of wastage of time, we can do both of them at the same time. But remember, we are using partial method to do for super and a partial method to do for sport. So we always start with purchase consideration. That is what I call PC, purchase consideration. So the purchase consideration, the parent paid how much to acquire super? The parent paid how much to acquire super? So you are told that the parent paid a certain amount here. So that is according to note 1. So you are told that Host Limited acquired as 90% of the ordinary share capital of Super Limited on 1st January 2005. So the purchase consideration, that is for Super, that is the purchase consideration for Super. You were told Host Limited acquired 90% of the ordinary share capital of Super on 1st January 2005, when the retained profit of Super were 1425. But now, how much did the Super pay, or how much did he invest in how much did the host invest in Super? So in some scenarios, you can be given in the additional information. You will be told, for example, now host acquired this Super, paying this amount. But now, if it will not be given the additional information, you will come back to your statement of financial position. So you always come back to the statement of financial position and check the investments. So you can see here right now, you are told investment in Super, and it will be under the parent because he's the one who invested. Like now here, so investment in Super Limited, is 6650. This 6650 is the one which invested in Super. So the investment of host in Super is 6650, and that is the purchase consideration. So 6650, that is fine. So how much did the host again invest in sport? So you need to know that when he was investing in sport, he invested indirectly, because you can see he invested through who? Super. He invested through Super. So investing through Super, and you know that the investment was 72%. That is the control. But now we need to get the purchase consideration. So which means that you need to go to the statement of financial position again. We check which is the relevant investment which is there. So here you can see the investment in sport is 3,800, and it's under Super because host used the Super to invest in sport, because host has an indirect control in sport, and they use the Super to invest in sport. That is why I was interpreting this structure. So which means that in order now to get the purchase consideration, you need to take the 90% of that investment. 90% of that investment. Because it was not a direct investment. It was an indirect investment through Super. That is why when you can see the investment is under the column of Super. So the 3,800. So if you take 90% of 3,800, What are you getting? I'm taking 90%, not 72, because host controls super up to 90. It's only that host controls spot indirectly through super by a percentage of 72. That is after taking 90 times 80. But for the investment, he used the super who he controls 90 to invest in spot. So 90% of that relevant amount.
3420.
That is
3420.
3420. That is fine. So 3420 is what to record here. Then we raise the net asset, share of net asset acquired. So we have to raise the net asset. So for the net assets, you need to know that since you are given a statement of financial position, you just pick them direct. So you can see we are given ordinary share capital and retained profit. So that is supposed to be that way. So which means that ordinary share capital, 3,000 for this for super, 2,000 for spot. The retained earnings 24,075, 19,898. So for ordinary share capital, it's okay. But for the retained earnings, I need to show you something. So for the ordinary share capital, so you need to take 90% of 3,000. So 90% of 3,000. And you need to take 72% of 2,000. So 90% of that amount is 90% of 3,000, 2,700.
Yes.
Then 72% of 2,000. That is 1,440. So the next, another equity item is concerning retained earnings. But for the retained earnings, you have to use the figure as acquisition. The figure as acquisition. When I say as acquisition, I mean the figures which we are supposed to use for the retained earnings is the one as at the date when super was acquired and as the date when spot was acquired. The same way if there was a revaluation reserve. So for the revaluation reserve, you need to use the figures as acquisition date again. So which means that for the retained earnings, I cannot pick the one which are in the statement of financial position. The way we have done for the ordinary share capital. Remember, for the ordinary share capital, we have just taken the one which are here. But for the retained profit, I cannot pick the one which are here. But I have to check, did they provide the retained earnings as at the time when super was acquired and as at the time when a spot was acquired. That's why they told you here in addition information number 1, Post Limited acquired 90% of the ordinary share capital of super on 1st January 2005 when the retained profit of super were 1425. When the retained profit, so as at that 2005, the retained profit was 1,425. That is for super. Subsequently, Super Limited acquired 80% of ordinary share capital of Spot on 1st January 2007 when the retained profit of Spot were 950. So you can see you are given. So that is what you use. And again, I said, the same way you will do revaluation reserve. So revaluation reserve, again, the figures you have to use, they must be as acquisition date. So you need to pick 90% and 72% of the relevant figures as acquisition date, which we already have. So that is 1425. And we have 950. So 950. So 90% of 1425 is
1,282.5.
so 1282.
0.5.
And the other one? 72 per 684. So there's nothing else. There's no another equity item. There's no another equity item. So now I need goodwill. So those are the only equity items we have. So maybe other question you will come across revaluation reserve and the share premium. Of which revaluation reserve I have said that you treat the same as retained earnings. So someone need to do for super and someone need to do for the sport. So after getting the goodwill now, we need to impair. We need to check if the examiner provided us with impairment. And remember the impairment I have to consider, the one I have to record in the income statement is the one for the year 2010. For the year 2010. So the one for the ending 31st December 2010 and 1st January 2010. So this is the one I will take to the income statement for that year. But remember that these entities, one was acquired in 2005 and another one was acquired in 2007. And the goodwill is always computed from the date of acquisition. So which means that we have computed the goodwill from 2005 and for 2007. Goodwill is not computed as at 2010. The goodwill we have computed is as at the date of acquisition of those investing companies. So we have determined, Post has determined the goodwill of Super as at 2005 and the goodwill as at 2007, which will be there in 2010. So let's check if they mentioned anything concerning impairment. And interpreting those dates, there's a meaning. That is why I started by talking about those dates. There's a meaning behind that, and that meaning is coming out shortly. So note 5, they said the entire goodwill of Super had been impaired, and by 31st December 2009, 60% of the goodwill of Sport was impaired. By which date? 31st December 2009. So by 2009, by the end of 2009, the entire goodwill of Super was impaired. And the 60% of the goodwill of Sport was impaired. To be specific, by December 2009. So that one can never be the impairment for 2010 because that is immediately 2009 before we enter 2010. So since we computed the goodwill from the time of acquisition, reaching 2009, the entire goodwill of Super has been impaired. That one we call it accumulated impairment. We call it accumulated impairment. So that is accumulated impairment. So which means that the entire 2667 has been impaired. Then 60% of this is impaired. So 60% again of Sport. 60% of Sport again is accumulated impairment because that is by 2009. So 60% of this you are getting
777.6.
that is 777.6.
Yes.
So now if you minus 1296 minus your answer, so the goodwill now which is remaining here is
518.4.
518.4 because now this one already has been entirely impaired, so we don't have anything again to subtract from there, and that is accumulated. Then they continued saying under that additional information, they said that an additional half of the balance of the goodwill in Sport is now considered impaired. additional half is considered impaired. That is now for the current year, because now after 209 is the information given above in the first sentence. Additional now will be in 2010. So an additional half of the balance of the goodwill is in sport is considered impaired. So that is now in 2010. So 60%, not 60%, a half of 518.4. So half of this.
259.2.
So this is now the impairment for the current year. So half of 518.4. So you have said that is
259.4.
259.4 or 0.2. Where is 4 coming from?
Point
Because
2.
0.2. So now the unimpaired goodwill unimpaired goodwill is the balance, the same half, 259.2. So which means that the impairment I was looking is just for 259.2 for the current year. Because now the other one, the 2667.5, the entire goodwill was impaired by 209 before even we come to the 2010. But at least for sport, after the impaired 60% by 209, the additional half of the goodwill was impaired in 2010. So when I go to my income statement, what I record as impairment is 259.2, this one. So this is the 259.2. 259. So now we can be able to get everything there up to the profit after tax. So take 64,205 minus subtract 73. Subtract 73.62 minus 63.25 minus 259.2. Give me the figures.
258.8.
50?
258.8.
258.8. Subtract 325.
49,933.8.
49. 933.8. Subtract 17,931, which is tax.
32,002.8.
So this is 32,002.8.
2.8.
So this is now the total profit. So the total profit. So that is the total profit which the parent has consolidated concerning the university companies which he acquired. But I said that the parent never controlled these university companies up to 100%. For super, there's a 10% which he doesn't have control. Then for sport, there's a 28% which he doesn't have control. So which I'll call the non-controlling interest. So we need to get the profit attributable to non-controlling interest. And you cannot take 10% and 20, that is 28% direct and multiply with this. You cannot do that. Some students think that, but you cannot do that. So what we have to do, there's a working, we need to compute it again. So whereby we have to adjust the profit of the subsidiaries. Because now the non-controlling interest is the percentage which is unacquired in those subsidiaries. So in order to get now the profit which would be part of the non-controlling interest, we have to adjust the profit which was in that subsidiaries. Either the profit in those subsidiaries was overstated or it was understated. So let us go forward and do the working in order to determine the profit attributable to NCI. And at the same time, we can compute this non-controlling interest to get profit. What I will be doing, Then when I will be coming to the statement of financial position, again, we will do another working for the NCI to determine the capital. What was their capital in these relevant investments? That one will be done under the statement of financial position. But for now, what I will be doing is to determine the profit. So profit attributable So profit attributable to the NCI. This is another working. So this is super. And here we have spot. So of which we need to adjust the profit after tax the way I've said. So profit after tax. So we need to start the profit after tax in those subsidiaries. So we subtract UPS if sales upstream. If sales upstream. So which means that if this subsidiary, super and sport, sold goods to sport, not to sport. Like now, if super, remember that it was a host, we have super and we have sport here. So if this one sold goods upward and the sport sold goods to this one. So which means that if we sold goods to the parent and this parent never resold, it means that the profit this parent never realized, this one realized. So which means that the profit here is overstated by what the parent never realized. So which means that this profit is more by what the parent never realized. So we need to subtract to bring the profit to its normal state. That's why I say if sales upstream. The same way, if sport sold goods to super, the same explanation applies. Then we raise depreciation, depreciation undercharge. Because now if you understated your depreciation, obviously the profit was more. If you understate your expenses, profit is more. So in order to avoid that, you need to subtract. Then if you overcharge, the profit is less. So you need to add back overcharge to bring the profit to its normal state. Depreciation overcharge. Then finally, we need to raise impairment. We need to raise what? Impairment loss. So for this one to be applicable, we might have used the full method. Because remember, we are dealing with NCI. So when you use full method is when you get the goodwill of the parent plus the goodwill of the NCI, then you impair. Goodwill of the parent and goodwill of the NCI, then you impair. But now if you are using partial, remember that you impaired only the goodwill of the parent. So for this one to be applicable, and this is NCI you are doing, you must have used the full method. At least the NCI must have contributed to the total goodwill which was impaired. The total goodwill which is impaired. So that is why I say in order for you to use impairment here, you have to use full method. Because now the goodwill which is impaired was from both the parent and the NCI. So the NCI contributed. So what was the profit after tax? So let me display again. So the profit after tax here So the profit after tax here, the profit for the period, 10,760 and 94.39. So that is the profit for the period. 10,760 and 94.39. So we need to raise UPS. Was it an upstream sale? Did the super sell to host? Did the sport sell to super? That is what you need to check. So it was that way. So you can see here, note 2, spot sold to super, that is an upstream. Note 3, super sold to host. So those are upstream sales. Those are upstream sales. And remember, it was 15-15. You remember how we did UPS? Unsold goods terms, profit margin. Unsold goods terms, a profit margin. Undercharge, there was no undercharge because there was no revaluation. Depreciation overcharge, there was depreciation overcharge, which we already computed. We got a figure of, there's this one we computed here, 8. And this was concerning which entity? Was it super or a spot? Who sold this entity? So it was not 4. During the year, host sold, but he sold to super at the selling price. So this was concerning goods sold. Oh, this was concerning fixed asset. That is not 4. During the year, host limited sold an item of plant to super at the selling price of 240. So host sold an item of plant to super. So it was concerning super. So the 8 is concerning super. So it was so the 8, that is depreciation overcharge, we record under super. So this one is not there. Then remember that when we're doing goodwill, we never use the full method, we use the partial. So give me the answers. So this is the adjusted profit. So the first one I'm getting 10, 753. Is that fine?
Yes.
Then the second one? Give a minus 15. There, 9424.
24.
So super, it was 10% the NCI. So take 10% of 10, 73, that is 75. So then for the other one is 28%. So 28% of 9424. So add the two. So this one is supposed to be 3714.02. 3714.02. So after our working, we have 3714.02. After the workings, we have 3714.02. So take the total minus the, take 32002 minus 3714.02 so that we can be able to get what is attributable to the parent. Because out of the total 32002.8, if you minus 3714, which is going now to the NCI, non-controlling interest, you can be able to get now what was remaining to the parent. So that is 2002. You minus 37, 14.02. 28,
288.78.
288.78. And that is how you were supposed to do the income statement. That is how you were supposed to do the income statement. So when we meet next time, that is on our next session, we'll be able to do the other part which is remaining. That is the statement of changes in equity and the statement of financial position. So for the statement of changes in equity and the statement of financial position, they don't require a lot of time, but this one needs a bit of time. That is why we have taken a bit longer to finish the income statement. So you can have a nice time, continue your revision, and you can see that CASNEP just extended the period of registration for exams to 31st July. It was supposed to be on 10 July, but it has been extended to 31st. So you have time to arrange for your finances so that if you have not paid for the exam, you can pay. Of which I projected that again, the examination date might be pushed ahead because this period is a bit limited.